Hello and welcome. My name is Larissa Greene. I'm with Advanta IRA, and today we're going to talk about how to start investing your IRA in real estate. And I can absolutely answer any questions you have, but you'll see as we go through the webinar, this is really sort of an introduction to using a self-directed retirement account in order to invest. And we'll talk about different things like accounts that can be used, structures of deals and prohibited transactions. And then I'll also do some case studies to really help you understand how these deals can work within an IRA account. Please make sure to type any questions you have into the question box. I'll get those answered as we go through the webinar. I also did load the slides as a handout. So if you look in your right-hand navigation, you're going to see the handouts box. You can drop that down and find those slides saved for you there as a PDF. Again, my name is Larissa Greene. I'm with Advanta IRA, and I've been with Advanta since 2011. My contact information is here, so if you have a question that you feel is maybe too personal for the webinar, as far as your different types of accounts or deal structures that you're looking at, you are welcome to reach out to me. That is my direct extension as well as my email address, and you can also use the QR code to find more information about me and how to reach me. We're going to talk a lot about the rules today and deal structures that we've seen, but please keep in mind that we don't provide any investment advice or endorse any products. Everything is for educational purposes, and we don't give you advice, whether it be tax, investment, or any other type of advice for your accounts. Ultimately, you want to deal with your attorneys, accountants, and financial advisors for any questions that you have regarding your specific deals and structures of investments. You'll see that there are a few rules for self-directed IRAs and different ways to look at deal structures as to whether or not they'll work within your retirement accounts. But just keep in mind that these are the takeaway points I really want you to focus on. Anything else, you can always call and ask questions, review the webinar, or check out any of our other webinars that we have. But any IRA or former employer plan qualifies to be self-directed, and we'll talk about that actually in just a moment, and you'll see why we specify former employer plans. You choose the investment, so we actually don't sell anything at all. We simply hold the account, you find the investment, we help you get it done in the name of the retirement account. And then when we're talking about real estate, all of the normal things apply to a real estate investment. So there's going to be expenses, including taxes and insurance, closing costs, all of those things, but then also income. And so keep in mind, all expenses are paid by the IRA and any income is received by the IRA. And I feel like those are really important points when you're looking at these types of investments. We're going to talk more about how to open an account and what those look like, but we also want you to know that Advanta has been around for over 20 years. We have over $3 billion in assets under administration. We actually have 2 offices, and we can help people nationwide and even worldwide. So when you're talking about a self-directed retirement account, it just has to be a US-based plan. So we have clients that live abroad that work for US-based companies, and they can self-direct those accounts as well. So as long as it's a US-based retirement account, and some employer plans qualify as well. So what is a self-directed IRA? A lot of people tell me that they have a self-directed IRA with a brokerage account, and so they can choose investments, the amounts they want to invest, and when to buy, sell, trade. But our definition of a self-directed IRA is something much more specific. Here we're talking about taking control of your retirement account and typically investing outside of the market. And so when we're talking about investments, again, we don't sell anything, so you have to take control of that account and put on your entrepreneurial hat and find those investments that you want to make and have true control over this account. So it's really going to give you the opportunity to diversify because this is not an all or nothing strategy. So you can move over just the amount you want to self-direct in order to buy real estate, and you can transfer between IRA accounts as often and whenever you like. So that gives you the ability to move more funds when you're ready to make a new investment, and also move back to investing through a brokerage account with any income you might have received on this investment. And when we're talking about a self-directed IRA, again, we're talking about things like real estate, private mortgages, precious metals, and the list truly goes on. And I have a few slides to really illustrate that in just a moment. If you haven't heard of a self-directed IRA, or at least our definition of a self-directed IRA, it's probably because there are a lot of companies that will hold assets based in the market, but they're unwilling to hold private investments. And so there are not a lot of companies out there like Advanta IRA who are truly set up for record keeping these types of investments. And this has always been allowed. The IRS has always allowed you to do things like buy real estate. It's just not commonly known because brokerage firms don't offer those opportunities. People typically choose to self-direct simply because it's a new source of capital. So they're kind of hearing about this for the first time. They're looking to their retirement accounts for that cash they need to make the investment that they want to make outside of the market. But they could also be tired, and this is very typical of the stock market, just kind of on that roller coaster ride that exists in the stock market. And again, just being able to diversify. So, it's not all or nothing. They can move a portion of those funds in order to diversify and get out of the market in some strategies. And then, of course, the tax benefits. So investing through a retirement account gives you the opportunity to realize tax deferred or tax-free growth, depending on the type of account you have. So there are a lot of benefits to self-directing your retirement account. So as I mentioned, there's not really a definitive list that the IRS has provided us in order to know what investments we can make. Instead, they've given us some rules. They've said, okay, this is what you can't do. Here's the assets you can't invest in. And those lists are very short. And so something that we like to do is provide you with information on assets that we see pretty commonly at Advanta. And of course, real estate tends to be one of the more common investments. And those could be single family homes for long and short-term rentals, rehab projects and condos, but it could also be mobile homes and mobile home parks. It could be tax deeds. So, bidding on property at a tax deed sale, real estate investment trusts and syndications in order to pool funds and buy larger properties, maybe into a commercial property, apartment complexes, again, mobile home parks, things of that nature, all real estate based assets, something that a brokerage firm does not hold. We also see a lot of mortgages, so private mortgages. Maybe you're lending money to a friend to rehab a property, or you're interested in learning more about something like earnest money deposit lending, or things of that nature. But mortgages tend to be pretty common. Tax liens, so again, related to tax deeds, depending on the state you're in, you can bid on liens on property when individuals are behind on their property taxes, and that gives you the ability to earn some percentage of the amount, and that gets returned to your retirement account. We also do see unsecured notes, option contracts, joint ventures, and the list for paper assets could go on and on. And similarly to real estate, I would consider something like a limited partnership investment a paper asset for an IRA. So you kind of get best of both worlds. You're a more passive investor, but you have the opportunity to invest in real estate. And then other alternative investments that we see, LLCs, and I'll talk a little bit about LLCs for checkbook control for real estate investing. But we also see things like farm animals and movie projects, equipment leasing, Forex accounts, commodities, and the list goes on. And I often get asked, well, when do people decide that they're going to make these less common investments? And really what we say at Advanta is invest in what you know best. So we might have somebody who's in the movie industry saying, I want to invest in a movie project because I understand that investment, or equipment leasing, or investing into private stocks, so private companies, for example. So there's a lot of opportunity to invest in what you know best and put your money in a market to grow that you understand. Oftentimes people are under the impression it has to be a Roth IRA in order to self-direct, and I'm not really sure why that might be, but the truth is if it ends in IRA, it can be self-directed. So traditional, of course, being the most common type of IRA account that we open. Many times people will say to me, when I'm filling out the application, I don't see self-directed on your application. Advanta only holds self-directed retirement accounts. So when we say traditional IRA, we don't mean traditional as in traditional assets. We mean traditional IRA, meaning a pre-tax retirement account. So that's the definition of traditional IRA. But then we can also help you with Roth IRAs and of course inherited IRAs. We can also assist with savings accounts, so health savings accounts and education savings accounts. And the reason for that is the rules for self-directing those accounts are going to be exactly the same as the retirement accounts. And so we can certainly help you with those. And then plans for businesses. So typically we're going to be assisting with plans for smaller businesses. Solo 401ks can only have the equitable partners and their spouses as employees in the plan. No regular employees can participate in a solo 401k. And so those are going to be, of course, smaller businesses, but then also SEP IRAs and simple IRAs. Again, small business plans to help you save as your own employer and employee. Something I want to note here as we go through the different types of plans is for you to just keep in mind that contributions versus earnings, those are different. Many times people will say, well, I want to put my annual contribution in, but then I still want to be able to make an investment and earn, but I don't want to max out the contribution if I can't also invest and have earnings. And contributions versus earnings, earnings are unlimited. Those do not count towards your annual contribution. Your annual contribution limit is going to be based on the year and the type of account. This year, for example, it's around $7,000 for Roth and traditional IRAs. And of course, you could have a higher contribution limit depending on the type of account and your age. And so you have that benefit depending, again, if you're self-employed, to really maximize your contributions. But that does not keep you from investing and having those earnings, because earnings are unrelated to contributions and they're unlimited. So I mentioned we were going to talk about the rules, and keep in mind there's no definitive list for the things that you can invest in. Instead, the IRS says there are some things that you cannot invest in, and there's only 2 asset classes there. And then there are people that you cannot transact with, and we're going to look at that, and I'm going to give you some examples so you can really understand how you can structure these investments within the rules, and you want to be careful about those that you are dealing with. So prohibited investments, there's only 2 asset classes, life insurance and collectibles. So you cannot invest in life insurance through an IRA or a collectible, so something that's considered antique or rare and its value is based on that would be prohibited. Some coins are allowed. So we did talk a little bit about precious metals when we were looking at the asset classes, and that is allowed. There is actually a list of precious metals allowed, and those are going to be based, as long as they're based on the value, having the value based on what the metal is trading at. So nothing that would be considered rare or antique, but rather something that is based on the value of that metal. Prohibited transactions would include a transaction between the plan and any individual considered disqualified, the IRA owner or a disqualified person receiving a benefit from the assets of the plan would be prohibited, and that comes from section 4975 of the IRS code. And I do have examples for you on the next slide where we're going to talk about that. And then the third box here does not make something prohibited, but it is a part of the rules, something you do want to be aware of. It doesn't mean if a tax is triggered that you cannot make that investment. You should be aware of it though, in case it applies to the investment you're making. And this tax is called unrelated business income tax. And it applies if business income is going to be received by the IRA. Now, think about that for a second. Typically, you're going to have passive income being received by the IRA. Long-term rental income, interest payments, dividends, these are all typically going to be considered passive. But if business income is going to be returned to the retirement account, then it's going to trigger UBIT. And then also, if your IRA finances the purchase of real estate, or if it's invested into a structure where there is financing on real estate. So I mentioned that because limited partnerships are a pretty common investment. And if you're investing into a limited partnership with your IRA, and that partnership is going to purchase real estate and finance, then it is going to apply to your IRA. And there are some exceptions. There are some ways to mitigate that, but for the purpose of this webinar, I'm not going to go into that, but we do have a webinar that talks all about unrelated business income tax. So if you think that it may apply to an investment that you're looking at, please feel free to send me an email and I can share that webinar with you. So looking at this chart, you're going to see the IRA holder there in the center. And so who are disqualified persons? That's going to be the IRA owner and their spouse. So for example, my IRA cannot transact with Larissa as an individual. So any investments that I have already personally, the IRA can't buy any portion of those investments. It can't pay the money to rehab a property that I already personally own, for example. But that also includes my spouse, my parents, my grandparents, my children, my grandchildren, and any spouses or business entities of those. And so when you're looking at this chart, keep in mind that the idea is that not only can you not transact with them, but those individuals or entities cannot have a benefit from the plan. So if you said, well, I am going to buy a rental property and it's going to be a vacation rental and my family is going to use it when it's not being rented out, that would be prohibited because there's a benefit to them for that investment. So keep that in mind when you're looking at making investments. Who's not disqualified? Well, that's brothers, sisters, aunts, uncles, cousins, and other distant relatives, friends, and colleagues. However, dealing with any individuals, even if they're not technically disqualified, at an arm's length basis will be really important here. So what does that look like? You know, making sure you're making investments for the sake of making the investments and not because you're looking at the personal benefit to you. So for example, if you said, well, I'd really like to lend my brother money to buy a house and I don't care if he ever pays me back, well, that's not really an investment, and that's probably something the IRS is going to take issue with. So just really quickly, I want to give you some examples of prohibited transactions. So selling, exchanging, or leasing property between the IRA or the plan and a prohibited or disqualified individual, lending money or extending credit. And what we're meaning here is that if you lend money to yourself personally or lend it to a spouse or lend it to a child, that would be prohibited. But extending your personal credit is also prohibited, and having an individual that's considered disqualified extend credit would also be a problem. So meaning that you cannot sign a personal guarantee for any loans or investments that you're making within the retirement account. You also can't furnish goods or services or facilities. And so keep that in mind, that there is no self-dealing and there is no personal use. Everything must be at an arm's length. So here, your IRA purchases a piece of real estate from your son or daughter. And remember that those individuals are considered disqualified from from transacting with your plan, with your IRA. And so even if it were at fair market value, that would still be prohibited. That's a question I get a lot. Well, what if I, do an analysis and I find out that the property is worth XYZ? Can my plan, my IRA plan, purchase it from my son or sell it to my son, whatever it might be? And the answer is no. It doesn't matter if it's at fair market value, it's still going to be considered prohibited. Your IRA owns real estate and leases it out to your daughter. Again, that's transacting with your daughter. Even if it was at a fair market value basis, it's still going to be considered prohibited. Your father's IRA lends money to you or your son. Again, the interest rate does not matter. It's still prohibited. So you want to keep that in mind. This next one's a great example because we forget about these kinds of things and structures and what have you when you're looking at investments. But what if your IRA purchases real estate and hires your son or his company to perform the rehab work? Even if your son is not out there, it's still going to be something that is considered prohibited. So you want to keep that in mind. Now, if you happen to know someone through your son who is unrelated to you, who owns a company that does rehab projects, a general contractor or something, you can hire that individual as long as it's not benefiting your son. So you just want to keep that in mind. Your IRA makes a down payment for a property and you personally guarantee the mortgage. Remember, On the last slide, we talked about not extending your personal credit or giving a personal guarantee for these investments. So you can get a mortgage when you're purchasing property, but it's actually the IRA getting a mortgage, and you are not signing a personal guarantee or extending your personal credit. It is something that is possible, but you're typically going to see that with long-term holds and not necessarily rehabs. I don't want to say it's not out there, but that would be pretty typical, would be like a long-term hold, and you would be able to get a loan for that. This one, last one, is interesting. Your spouse's IRA owns a piece of real estate and wants to sell a portion of it to your IRA. Could you have partnered at the outset? So your IRA cannot transact with your spouse's IRA, so this would be prohibited. But partnering, even with individuals considered disqualified, is not prohibited. So think about that for a moment. If you had made the investment at the outset together, new to both of you, new to the IRA, you could have made that investment. It's going to be pro rata, and all of the income expenses are all going to be divided along that pro rata line. So it is something that is possible, and I do have an example of that towards the end. I had a question pop up here. So is it possible to invest in real estate outside of the country? Yes, it is. So even outside of the country you live, yes, it is. And where is the IRA LLC located? Honestly, it depends. We have clients that invest outside of the country, and you really would want to make sure you're working with an attorney or advisor that could help you understand what that country would require. For example, some countries require that you open an LLC equivalent in their country prior to purchasing real estate. The LLC you could have a US-based LLC that then invests in that country's equivalent of an LLC to then make the purchase. I'm going to leave that structure between you and your advisor, but you do want to make sure that you understand what that country will require in order for you to make that investment. The question also includes, can I get a copy of the presentation? It is loaded in handouts, so if you look in the right-hand navigation, you're going to see handouts. Drop that box down and you'll see the presentation there. If you have trouble for any reason downloading the slides, please feel free to email me. My contact information will be at the end. And thank you for the question. Keep the questions coming, guys. So we're going to talk now about the different deal structures that we see and how they work within a retirement account. And so for this first investment structure, we're going to just talk about purchasing real estate directly through the IRA account. So making that purchase, holding it through the IRA, what does that look like? And kind of the who does what of deal structuring through an IRA. So in this first example, Joe opens and funds an IRA account. And how do you do that? You just complete the online application. We help you with the transfer rollover. And when we say transfer funds, we mean something specific. A transfer is IRA to IRA. We have you fill out a form. We help you move the amount of money over that you'd like. A rollover is from an old 401k. Sometimes you can use current 401ks, but you do have to check with the plan administrator. It is specific to the plan. Sometimes it has to do with your age, your number of years of service with the company, but that's why we do express typically that it's an old or former employer's plan. If you're rolling over from a former employer's plan, then we give you information you need and you reach out to them and we help you get the money over to us. Your account number is issued, and that's important because when you make your investment, and you're going to see this sort of as a theme throughout our discussion on deal structuring, the IRA has to be shown as the investor. So whether you're investing directly into real estate, so in the case of Joe, buying a piece of property, or investing in a limited partnership, or using an LLC, or lending money, you're always going to use the vesting for the IRA. So that demonstrates to the IRS that this is an investment of the retirement account. So here's in number 2, you're going to see contract is in the name of Joe's IRA. So once that account number is issued, now Joe can make an offer on a property. Advanta IRA, FBO, Joe Smith IRA number 12345. Joe is going to approve the contract, but ultimately Advanta is going to execute it. So keep in mind that Advanta IRA is the legal signer for your retirement account, so it's going to be important that we sign that contract as well. And Joe is going to let us know who it is that we're working with to make this investment. So he's going to make us aware of any real estate agents, closing attorneys, title agents, Whoever's involved in this deal, Joe is going to make sure that we're aware by completing our paperwork so that we can make sure that we're submitting things per Joe's request to the correct people. So once we sign, we'll submit it, or we'll turn it back over to Joe for him to submit it. And once it is agreed upon, now we're going to work on closing documents, and everything from contract to close is going to be in the name of the IRA, not in Joe's personal name. Remember that we are not advisors, so we're not reviewing this investment for anything specific other than to make sure that the IRA is properly represented. So we'll review, we'll make sure that we see that specific vesting, and then we're going to turn it over to Joe for e-signature so that we can have him approve the investment documents saying, yes, this is what I know I'm investing in, all of these numbers are correct. And once he reads and approves everything, then we go ahead and handle the closing on his behalf. I had a question pop up. Can we live in the property owned by our IRA? You cannot. That would be prohibited. So just thinking back to those prohibited transaction rules and disqualified persons, you would be unable to use the property at all. So I know if you're a real estate investor and you own property personally, there is some cutoff where it says you can use that property so many days a year. In your IRA, it is prohibited. You cannot use it for a day, an hour, a week, whatever it might be. It would be considered prohibited. So please keep that in mind. This is 100% an investment for investment purposes only, not for personal use. So after the closing, we're going to wire funds, and then Joe is going to secure the tenants. We're not property managers, but Joe can certainly hire a property manager if he'd like. Again, I'm related to him, so keeping that in mind, but he can also oversee the investment. So he can, work with maybe a company to screen a tenant, put the tenant in there. Remember that the IRA is going to pay for all expenses and ultimately sign all the documents. And then Joe directs that all expenses, tax, maintenance, insurance are paid by his IRA, and he can do that through his online portal. And then his tenant is going to pay Advanta directly. Now, if Joe wants the rent payments to go to his PO box, that's okay, but he wants to make sure that those checks are made payable directly to the IRA. So he's not going to take constructive receipt of those. He's just going to forward the check on to Advanta for us to deposit. But in many cases, tenants send checks directly to us, or they send us an ACH for deposit to the account for their rent. Now, Joe can hold the property indefinitely and continue to accrue rents in his IRA, or he can sell it at a profit. Remember, Joe is in control of this situation. So if he says, I'm going to have, short-term rentals or mid-term rentals, or this is strictly a long-term rental, whatever it is, Joe is going to make all of those decisions. And when he purchases it, if he feels it's in rent-ready condition, that is completely up to Joe as the account holder. Anytime there's an expense, he would just log into his portal and request that that expense gets paid. So I had a question pop up. Can you borrow your IRA money? The answer is you cannot borrow your IRA money. You can lend your IRA money to other individuals. So for example, we talked about private money lending in the form of a mortgage or deed of trust. You can also lend to businesses, but it can't be your business. And there are very few exceptions to that. You're basically making investments for investment purposes at arm's length. And so different than like a company 401k where you can borrow funds as the participant, you cannot borrow from your IRA. The 401k would be the only exception to that. Can I loan money to my IRA? No, that would also be prohibited. So again, keeping in mind that self-dealing, transacting with your IRA, you as the account holder, that would be something that's considered prohibited, and you just want to be aware of that. Okay, so we're going to talk now about purchasing real estate with an LLC, and you're going to see some differences here. Ultimately, this structure is considered checkbook control. So if you've heard of that term before, that's what we're going to be talking about here. Now, Advanta IRA allows checkbook control through an LLC or a trust, but ultimately we're going to leave it up to you. So if you're comfortable with the structure of that investment and that's something that you wanted to do, then you're certainly welcome to do it. But remember that we don't advise. So Joe opens and funds his account. So we're taking Joe's example again, but now instead of investing directly through the IRA, he's going to use an LLC to do that. And so how does he do that? He's going to open and fund his account just as he did before, but then he's going to choose the state to set up the LLC, choose a name for the LLC, possibly work with a professional to help give him legal advice, set up the LLC, and provide something very important here is the operating agreement. The operating agreement is basically going to tell us who is the member, who is the manager. This is a manager managed LLC, not member managed. Many people get that mistake, but the only member in this LLC is going to be the IRA. So what would be the purpose of this structure? Sometimes people like these structures for literally a checkbook control so that they can write checks to vendors, receive income directly to the LLC bank account. But ultimately, the IRA owns the LLC, and so you do have to be aware of prohibited transaction rules and disqualified persons even when you're using an LLC. This should be a new LLC set up for the purpose of the IRA, and the IRA is listed as 100% owner or the member. The operating agreement must show the IRA is the only member. And remember that specific vesting we talked about is here again, but in this case, it will go in the operating agreement. So who is the member? Advanta IRA for benefit of Joe Smith, IRA number 12345. And that's very important. When is there an exception to that? At times, people do use LLCs to partner with IRAs and non-IRA members, and that sort of ease some of the record keeping and can be done. And so then in that case, the members would be either all of the IRAs making the investment or the IRA and the individual, what have you, and it would list their share as undivided interest. So it could be Advanta IRA for benefit of Joe Smith, IRA number 1234 as to a 50% undivided interest, and Advanta IRA FBO Jane Smith, IRA number 56789 as to a 50% undivided interest. And that shows then that Joe and Jane's IRAs are investing together, partnering through this LLC. So Advanta IRA signs Joe's operating agreement after reviewing it. He's going to read and approve it through DocuSign again to make sure that we know for sure that he has reviewed it all, especially if it's coming from a third party, for example, an attorney that put it together for him. He can sign as the manager if he chose to be the manager of that LLC, and then we will fund the bank account. So Joe's going to open a bank account in the name of the LLC, and then we're going to send funds to the LLC. And now as the manager, Joe can sign off on the contract to buy the real estate. He's going to sign on all the closing costs and wire funds for closing. He, as the manager, will deposit the rent payments from his tenant and pay all of the expenses. And again, that gives him that checkbook control. So if you feel like you want to have checkbook in hand to make investments, pay for expenses, you want to be able to receive the income and do all the record keeping, you are welcome to do that. Again, just keeping in mind that there are rules and making sure you're comfortable with those rules. So something to be aware of. I used the example that Joe and Jane Smith could possibly be partnering IRAs into an LLC to make a purchase. And if they are, it's important to know that when an LLC is fractionally owned and there's a capital call, the IRAs would need to put up the same percentage of capital call to maintain ratios. So in my example, Jane and Joe owned 50, they own the LLC 50-50. They can only own the LLC 50-50 if they're able to each put up 50% of the initial funding, and then going forward, they cannot change that percentage of ownership. It's always going to be 50-50 because in my example, they're married and considered disqualified persons. So if they all of a sudden said, oh, the property in the LLC needs a roof, and we both need to put $20,000 or $10,000 into this for $20,000 total, and Joe didn't have the $10,000, he could always make an annual contribution to make up the difference. But if he did not, they would have to figure out a way, because Jane could not front the money for his IRA, that would be prohibited. So just being aware of those little nuances will be important. If the IRA owner puts up the money personally for the capital call, this would be considered prohibited. The manager of the LLC is responsible for making the investments, receiving and depositing income, paying expenses out of the LLC account. So again, being comfortable with that record keeping. And when the IRA owner wants cash dispersed back to their IRA accounts, The funds are returned to each IRA or party according to percentage of ownership. So if Joe said, I want to take money out of the LLC and send it to my IRA so I can take a distribution, then Jane would have to get her pro rata share. That's important. So with checkbook control of the IRA typically owns 100%, again, with the exception of partnering, and checkbook control allows the manager, IRA owner to write checks. But again, they should consult an attorney and make sure you're comfortable with that structure and make sure you're comfortable with being the manager of that LLC. As I mentioned earlier, you can also use a trust, but you cannot be the trustee of the trustee. You would have to have a non-disqualified third party to act in that way. IRA custodians who offer a one-stop shop for the IRA and the LLC for a checkbook control often charge lots of money to do that. There is no secret formula. You can work with an attorney or a CPA of your choosing to help you with the LLC and ultimately shop that service and find somebody that you'd like to work with. And if you're interested in reading more about the IRS cases where checkbook control kind of came up and was confirmed, Swanson versus Commissioner, and then reconfirmed through TL Ellis. And so you have those sites there. You can always check that out. Okay, so I'm going to go on to partnering IRAs on a real estate deal. I don't see any questions. Don't forget, guys, feel free to ask any questions that you might have. I just have 2 more examples here for you before we end today. If you did not have a chance, go ahead and check out the handouts on the right-hand navigation so you can download these slides. If you have any trouble, again, feel free to email me. My contact information will be at the end. So now we're going to talk about partnering directly through the IRA. So I kind of gave you that example of partnering through an LLC. But in this example, Linda and Paul will partner using their IRA funds. They're not going to use an LLC. They're going to go directly through their IRAs. They each have $100,000. They find a property for $150,000 and it needs $20,000 in repairs to get it rent ready. They estimate receiving $1,500 per month in rental income, and that income is going to go to their IRAs. Remember, their IRAs will be responsible for receiving any income, but also paying any expenses. Paul and Linda each open an account. So remember, IRAs are individual accounts. So if Paul and Linda want to open and partner, they're going to each open an IRA account. They already found their investment, and so they're going to be ready to purchase. We're going to help them transfer funds over to the IRA. And remember that their purchase is $150,000, but then they also still need $20,000 in order to get it rent ready. So in this example, we just made it easy. They're each going to bring 50% of what's needed to the table in order to make the investment, and they're going to own it 50-50. They're going to each read and approve all documents for the investment. And the deed, everything from contract to close, is going to be in the name of their IRAs as tenants in common. So Advanta IRA for benefit of, Paul's IRA number 1234 as to a 50% undivided interest, and Advanta IRA for benefit of Linda's IRA number 5678 as to a 50% undivided interest. IRAs are always listed as tenants in common. Percentages based on the amounts contributed from each IRA, no more, no less. And then they're going to share on the income and expenses. So remember that $20,000, they're each going to have to participate using $10,000 of funds to renovate, paint, clean, whatever it is that needs to get done. And remember, based on the rules, Paul and Linda cannot go out there and swing a hammer, mop the floor, whatever it might be that needs to get done. They need to hire non-disqualified third parties to do that. There isn't any definitive list of contractors or vendors for them to do so, but they have to do that with an arm's length. They also can't pay those expenses personally, so they don't want to front the money for any expense. They want to make sure that the expense is paid directly by the IRA account. So what happens if they're short on funds? We mentioned this a little bit with the LLC, but let's look at that a little closer. They can make an annual contribution. So if Paul had enough funds and Linda didn't, then she can always make an annual contribution. But if you've already made your annual contribution or the contribution isn't going to make up what is needed, the IRA can use a non-recourse loan. Remember that you can't give a personal guarantee. The loan is to the IRA, and the IRA or IRAs in this case will make the loan payments. In most cases, unrelated debt finance income tax or unrelated business income tax applies. And it could also be seller financing with non-recourse. So again, it has to be a non-recourse loan. You're looking for something with that non-recourse language in there. What are other options? If they're short on funds, they can bring in a non-disqualified third party to partner with them. So looking for another partner to come in and maybe buy a portion of the house or lend them money. But again, it would have to be a non-disqualified third party. And if it was a loan, it would have to be non-recourse. Paul and Linda could also have partnered, before I go on, Paul and Linda could also have partnered with themselves or another considered disqualified person, as long as they did it at the outset. So let's say, for example, that Paul was going to use his IRA funds, but then Paul and Linda as individuals were going to also partner into this investment. They, again, their shares would be pro rata, so based on the amount of funds brought to the table by both Paul and Linda as individuals and Paul's IRA. And then they want to make sure that everything is divided along that line. Paul's IRA can never buy them out. They can never buy the IRA out, but they could, again, get a non-recourse loan if needed. They could bring in a non-disqualified third party if they needed to down the line. But again, the investment needs to be for investment purposes, and they cannot benefit beyond their share of the investment. And so when you're looking at maybe partnering with yourself personally or with a non-disqualified person, or with a disqualified individual personally, we always suggest, of course, getting an attorney to help you with that transaction and making sure you understand the pros and cons. So the last case study that I wanted to talk about very quickly is private lending. Now, we do a webinar where we talk about private lending specifically. So we talk about those different types of private lending, the deal structures we see for those, but I just want to give you an idea, because I do feel like when you're lending, with a mortgage or deed of trust, that, this is another way to invest in real estate, but now you're not worrying about tenants, toilets, and termites. So kind of a more, could be a more passive investment. So Andrea and Steve decide to go into a joint venture arrangement together. She has $100,000 in an IRA, and she's interested in partnering with a rehabber to flip a house. She meets Steve at a local investment group, and he has a project that needs funding. She's going to do her due diligence on Steve and on the property he's looking to flip. Remember, Advanta IRA does not give investment advice, so she wants to make sure she feels comfortable with the deal and the person she is dealing with. Steve agrees to use the property for collateral and use some of his own funds as a down payment, and Andrea agrees to loan him the rest of the funds. The loan amount includes funds to purchase and rehab the property. Remember, this is just an example, but I want to give you an example of what we have seen. The really cool thing about private lending is that you get to be the bank, and so you determine the rate at which your IRA is going to grow. So you get to determine how much you're going to lend, what the interest rate will be in length of term. Is it amortized or interest only? Is there any equity participation? And are there lenders fees, origination fees, things of that nature? So in this example, the loan amount is $100,000 at 5%, but including equity participation of 1/3 of the profits, and a 2-year balloon note with a monthly payment. And I want to just express that it does not have to have a monthly payment. So this could be a no payment note. It could be a single payment note at the end, basically, I guess I should say, so that if you are comfortable with that, again, the IRS does not require that when you're lending money, you have a monthly payment. So if you said, you know what, Steve, I'm going to lend you this money. I know you're rehabbing. I don't expect you to make payments. We'll just consider this interest accruing, and I'll get paid, when the property sells, everything, including my principal amount, back at that time. Again, that is going to be completely up to you. But in this example, there is a monthly payment. Andrea's attorney prepares the note and mortgage, and she reads everything and approves it through e-signatures. And she also completes a form that lets us know who we are dealing with. So our purchase authorization form is going to let us know how much we're funding, where we're funding it to, who the loan is to, if there are monthly payments, if it's amortized or interest only. And then once she approves everything, we will fund it per her instructions. So if she says this is going to my attorney for closing, if this is going to a title agent for closing, whatever it might be, we're going to take Andrea's instruction. When Steve is ready to sell the property and pay off the note, he requests a payoff letter. Andrea will provide that to him through her attorney. And then it will get paid back directly to the IRA. So the repaid principal was that $100,000 because this was an interest-only note with the monthly payments over time of $2,500 total. She got a share of the profits, so $10,000, and she had total earnings of $12,500. And then I just Wanted to talk briefly about Steve's earnings too, because he benefited from self-directed retirement account investing as well, because he got the loan. So he had a loan of $100,000. He sold the house at $130,000. He repaid the loan, including his interest payments, and his total earnings were $17,500. So I often talk when I'm at real estate investment groups about how even if you're not ready to start self-directing, if you are investing, then knowing about a self-directed retirement account and just the basics of how they work, that can help you raise capital, because IRAs tend to be the most liquid asset people own. And so when they say, well, I'd like to invest, but I can't, I don't have anything liquid right now. If you said, well, did you know you could use your IRA to make this investment? It might help you raise capital. So it does not have to be real estate as collateral. It can be non-real estate assets, but just keeping in mind that if you are going to lend money secured by a non-real estate asset, that you're aware of how, repayment or possible collection will work. And even if it's a prohibited investment, something like a collectible, the note itself is the investment. But again, understanding how you might collect if there is an issue with repayment. So again, having your advisor, your attorney, your accountant help you understand those, different deal structures and how they work within the IRA. Again, I'm not going to talk about that today, but if you're interested in our webinar on private lending, please feel free to email me or check out our library. So if the note is secured by something other than real estate, again, how do you put people on notice, or how do you collect it? And also, who are you lending to? So for example, S corporations cannot have IRAs as shareholders. So if you're looking at something like a convertible note or something like that, again, making sure you understand the structure of the investment. So if you're investing with limited funds and you want to invest in real estate, there's lots of different ways to do that. Again, lending money. And I know a lot of times people say, well, I don't have enough money to lend as a mortgage or deed of trust. Well, the truth is those come in all shapes and sizes. And so you can lend just a little bit of money. You can partner IRAs, personal funds with other friends and individuals in order to put the money together to lend. You can borrow in order to make real estate investments like we talked about, or you can invest in things like tax liens where it doesn't necessarily take a ton of money to make those investments. We also see people investing through tax deeds for a little less money, and then also real estate options. So there's a lot of ways to invest when you have limited funds. So if you're listening and you say, well, I don't have enough money to buy 123 Main straight through my IRA, keep in mind there's lots of different ways to invest in real estate, and something might be a good fit for you. Remember our takeaway points. So any IRA or former employer plan qualifies to be self-directed. You choose the investment, and all expenses are paid by the IRA, and any income is received by the IRA. I mentioned our webinars a few times because we do have webinars that go into more detail about different deal structures and things that pertain to self-directed IRAs. And so if you're interested in that, you can definitely check out our website and find our video library. We are also on YouTube. Just search Advanta IRA and you'll find all of our archived webinars there, including private lending, checkbook control of your IRA. I also have one on unrelated business income tax, investing with small amounts of funds. And we also talk about partnering IRAs and non-IRA investors. So one other one I'd like to mention is capital raising. So there's a lot on our video library, and I would encourage you to check it out. But we also have a monthly virtual networking event. We have a podcast where we're staying up to date and having experts guide us through different trends and investment strategies. And then we also have a blog. So there's lots of ways to stay in touch with Advanta and learn more about the industry. I mentioned I would put my contact information back up here for you. So if you have questions and you didn't have a chance to ask them during the webinar, please feel free to reach out to me. You can reach me by my direct extension or send me an email. I don't see any other questions that have popped up. So I'm going to close the webinar, but again, please feel free to reach out to me. You will receive a recording of this webinar, so that will go out to you usually in less than a day, 24 hours max usually. And again, the slides are attached under the handout in the right-hand navigation, so I'll give you just a second to go ahead and check that out and download those slides. If I can help anybody with anything else, or you have a suggestion for a webinar topic, I'd love to hear it. Please feel free to reach out to me. Thank you so much for joining.